Hi, I have with me Jay Hatfield, the CIO of the midstream MLP ETF AMZA, and we're going to talk a little bit about oil markets today. Thanks for taking the time, Jay. Appreciate it.
Thanks, Jennifer, for having me on.
Sure. So, in the last week or two, there has been a lot of dissension about not only oil prices, what's driving it, but also very much dissension on oil supply. We've had like three different outlooks and estimates for like 2024. OPEC was on the higher side, nearly 106 million barrels a day. The IEA was about 103 plus. And the EIA, surprisingly, the US watchdog, was like 102.5 million barrels a day outlook for 2024. And there's been a lot of, especially this dissension was largely focused on the IEA, the Paris-based organization. Do you have any thoughts about all that?
Well, we do our own global estimates of supply and demand. And right now for next year, we're right around the lower estimates, like 103 million barrels per day.
Mm-hmm.
And the thing that I think most people miss, particularly the press, is that demand is quite sticky both directions. So there's always commentary, oh, oil's way down because there's a regional banking crisis. Well, okay, maybe the price of the futures are down and that drives the short-term price of the barrel down. But that doesn't mean that the supply and demand changed at all. Because there's a fear that it'll change, but actually have not changed. And that's why we've stuck with our ranges. We're at 75 to 95 this year. And demand is growing and OPEC's likely to constrain production. So that range is going to go up $5 or $10 for next year. So oil, we're bullish on oil, but a lot of the strategists on oil have blown themselves up by assuming that mostly that Russia would not be able to export its barrels. But we quickly realized that oil is highly both fungible and transportable. It's not like natural gas where you have to cool it to negative 250 degrees Fahrenheit. You can ship it on a truck, on rail, or actually ship it, put it on a ship. So very, very easy to transport. Once you start transporting it, you can't tell where it came from. In fact, this is why price controls in the 70s didn't work, is that it was horrible, but US production was capped way below the world price. But ultimately that never benefited consumers because the capped barrels kept getting marked up because you couldn't tell what was capped and not capped. And so same thing happens with Russian oil. And so demand and supply are more sticky than people think, particularly China does not collapse.
Right.
Just because if they're not growing at 6, they're growing at 3. That doesn't mean their oil demand is going to collapse. Maybe it's not going to surprise to the upside, but a lot of the incremental demand for energy is more like on the electricity side or coal.
Right.
Whereas it's pretty static on the oil and refined products.
Right.
So we think that these wild projections on the downside, we never were, participated in that. We just said, okay, oil's at 64. Our range is 75 to 95. It's implicitly a buy. I mean, it's pretty something you shouldn't really try at home. We don't even do it in our funds, in our speculative funds. Trade oil a lot. I mean, maybe a little bit, but it's a good way to lose money.
Right.
Random. But we do in effect trade it because we have the option to say, oh my God, yeah, everything's terrible and the world economy is going to crash because of this regional banking crisis. So we're lowering our range to 60 to 80 or something like that. But we didn't do that because we're like, well, there is no change in demand right now. And we didn't think the banking crisis would be that big an effect on the US economy. And so I think that there are a lot of people who are seeing this momentum trade go up, but it's just important to know oil tends to overshoot. Number one. And number two, this is a horrible time frame for oil. I mean, the fundamental demand is low just because we're in the fall, shoulder months. So we think we're going to stall out within our range. But we're not like writing you a call option at 95. I mean, oil markets do tend to overshoot.
Mhm. So you think that regardless of price, OPEC will probably stay the course, OPEC plus. I mean, Russia doesn't seem to have a lot of sway in some respects. They're already doing what they're doing, moving barrels around, shifting amongst different, ports of exit, entry, and that sort of thing. And yeah, I was going to ask you about the sticky factor, and so you answered it, but that basically, yeah, the stickiness, the inelasticity of demand and supply, just the slow movement of them just kind of trumps all of the noise of, who says what and who's on first and what's on second. Yeah, because I even saw that there was like even Exxon and Aramco at a conference, they both were refuting, the IEA, what they were saying about 103 in 2024. And they were also, and peak demand. And they were just saying that, Aramco was saying it's going to be, supply is going to be 110 million barrels a day in 2030, and then just stay the course. That's pretty hard to say that high, that far out, it seems to me.
Yeah, we don't try that. We don't have a 2030 for, we're not that good. It's hard enough to do it within the next 3 months versus 10 years.
Right. And that gets at something I was thinking about too. We have all this constant, information about EVs. Everyone would think, we're just going to this all EV world, but it's really, it's largely policy driven to a great extent. It's largely, higher incomes, for the most part. And I saw this article about, EV graveyards in China, which means overproduction. And then you have this, potential strike, what's going on, in our auto industry. Have you guys thought about how you really see EV penetration impacting oil supply, like over the next 5 years or 10 years? Or, I mean, do you kind of have any thoughts about that?
Well, I was a renewables investment banker 33 years ago, and they were working on an electric car back then using fuel cells. And so what that historical perspective gives you, and everybody was excited that it was going to happen very quickly, and it just clearly has not. So particularly in the US, the penetration for pure electrics is going to be very sluggish because of just the geography of the United States. It's okay if you're in San Francisco and you're wealthy and you have 3 cars and you use your Tesla to commute. But if you're in Montana and you have a Tesla, you might die during the winter if you don't charge it properly. So it's not going to be super
practical,
popular, or practical there.
Right.
And what's really, in a way, the visionaries have hurt the penetration and the environment, because hybrids are spectacular. I have a hybrid.
Yeah.
I wish it was a plug-in hybrid, but it's a large car for my family. It's a Sienna, but it gets like 38, 39, 40 miles a gallon. And so I think would have been way better if we just mandated that every car is a hybrid. All it is expensive, or a plug-in hybrid, or give incentives for that.
Yeah.
And be more practical, particularly in the United States. And the other point about the energy markets is that it doesn't really matter that you have electrics or internal combustion, because energy is utilized. And where that historical perspective is more relevant, because there weren't any electric cars being produced then, but there were windmills and solar 35 years ago.
Right.
Right now, the penetration in the US for all energy use, not just electricity, is less than 5% for wind and solar. And there's diminishing returns. So in other words, you use up the best places to do solar, like in the Mojave Desert, the best places to do wind. And they're finding that out, like, oh, let's do it all offshore. Well, it's a lot of opposition to doing it offshore. Very difficult to site it. Less economic than doing it in Oklahoma or Texas, West Texas. So there's diminishing returns. So people are not being realistic about it. So if solar and wind, they're right now they're 4 or 5% total, growing at 10, maybe they grow at 20, but that means 5, 6, 7, 8. Like, so there's going to be ongoing demand for energy. It doesn't really matter. Like outside the United States, natural gas trades the same cost as fuel oil, diesel, and gasoline. So, if you don't use gasoline because you have an electric car, then that's going to displace some other fuel. And we're going to need the same amount of energy, and renewables can only grow so fast.
Right.
We should be focusing on, and we will need to shut down the coal if we properly price carbon.
Right.
We may not, because there's not a lot of political will do that.
Right.
So we just believe, at least for the next 30 years, there will be a gradual increase in the need for energy, particularly because India and China continue to develop. The whole developing world is slowly developing. They need more energy. So the US is probably getting closer to maximum efficiency as well. I'm certainly on the electric side, they're pretty close to that. So the right approach is to sort of, I think, stick to our kind of sticky notion that demand gradually grows, supply gradually grows, renewables gradually grow, electric cars, slow growth. Hybrids hopefully will grow faster if people focus on them more. Right. They're just way better, more practical, because nobody talks about it, but if we had all electric cars, the production of lithium would have to go up 10,000 times.
Yeah, it's huge.
And so the price would go to infinity. And somebody did a nice article that said, well, with hybrids, you only need, like, you can make 45 hybrids for every pure electric. So these people are not being practical, but where we see the biggest opportunity is natural gas, because the US is the Saudi Arabia of natural gas. We have a massive surplus because it's a byproduct of drilling for oil, so we have too much of it. And we're going to increasingly export that. So it's a huge growth opportunity for the midstream, the US with gas leverage. And it's great for the environment. Eventually environmentalists, so they're already figuring this out. So Europe blew up in their energy transition. But the near-term opportunity is not to go back to the Stone Age like a lot of extreme environmentalists think, but is to shut down all the coal and substitute natural gas. That could cut global emissions by about 22%.
Right.
Typical. I mean, you can't do it infinitely fast, but if we could get a 22% cut, that would be a huge home run. And that's all technology we have. Just burning natural gas and not burning coal.
Yeah, I was going to ask you too, since we're talking about natural gas, and there is this, that it grows globally, and does all the things that you were talking about. What about, the Henry Hub price, in the United States is low, lowish on the low side, and it doesn't increase a lot according to forecasts. And then there's been that idea of, that there is a growing global gas market, and at some point you'll see more convergence, like you've got the, what is it, the Dutch TTF, and, and then the Japan price. What are your thoughts about that?
Well, the easiest way to think about natural gas prices is to convert it to oil. And this gets back to my point that energy is relatively fungible. Right. Because there's enough capacity that can switch. And so the markets tend to get balanced out by that switching. And you don't have to switch 100%. If just 20% shifts from natural gas to fuel oil, they can balance those two. But so natural gas in the US, excuse me, using 3 as a simple number, it's below that right now, but would be 3 times 6 is 18. So there's 6 to 1 ratio of natural gas per MCF to a barrel of oil. So $18 in the US. So that's one reason why we have lower inflation in Europe, because it does translate into electricity as well. So we have no increase in the cost of the commodity portion of electricity or natural gas. So that's a huge deflationary element. And in the rest of the world, not surprisingly, it's roughly around $90 a barrel, which is where oil is. In other words, if you take natural gas, multiply it times 6 overseas, it's like $15 or a little bit less than 15. So 6 times 15 is 90. A little bit over 90. So That's proves the fungibility for natural gas. Now, when will the US's 18 become 90? It's going to be challenging because just the US, the mid-continent of the United States, like if you've ever been to Utah and you look, you could sort of tell that there was probably a sea there at one point. Well, there was through the whole middle part of the United States. And seas produce hydrocarbons, so, and natural gas is associated with oil. So we both drill for regular natural gas, but also it gets produced by oil production with oil production. So it's not clear when that surplus will really get eliminated. And so that discount should continue. But during the winter, like we did spike up to $10. So the winter is a big variable. So maybe we go to 10, 11 again if it's a cold winter here and in Europe. But it's very volatile. There is more upside than downside, we would argue, but it's called the widowmaker if you want to trade natural gas because it's extremely volatile.
Yeah.
Partly because it's used for electricity. So it's absolutely needed, as you found out in Texas.
Yeah.
You can't do without electricity. You can do without gasoline briefly, like the Colonial Pipeline went down, but you cannot do without electricity. So if you need natural gas to produce shorted electricity when there's a shortage, the price can become nearly infinite, just like it did in Texas when you had freeze-outs. So that's one reason natural gas, because it's difficult to transport, unlike oil, and it's used for electricity. You cannot do, in modern society, cannot do without electricity. You can do without natural gas,
Right.
have shortages, but a lot of people's lives are absolutely, even their health is dependent on having electricity.
Right. Yeah. We, aside from Uri, which I experienced with, no power for a few days and finally having to escape to some, drive in the ice to someone's house that had power. This summer, we had practically 3 months of triple digit heat. And towards the very end of this 3 months, the last 2 days, we finally got these yellow flag warnings where they were saying, everybody needs to cut back, don't run your dishwasher, unplug your EV, all this. And it was like, and I did see that the price was up, and I was just thankful that, they had done all that thinking post Uri about the need for dispatchable resources, i.e. natural gas, because the renewables were just not going to cut it. You just couldn't count on it, and people don't realize that, that is something that.
Yeah, and one just detail about that is that I think the mistake Texas made was it's totally free market.
Yeah.
And so the notion would be somebody would say, okay, well, I'm going to fund a peaking power plant. So in other words, a backup power plant, because for 2 hours a year, the price will be infinity and I'll mint money. But you can't finance that.
Right.
Whereas where I am in New York, it's called PJM. They have something called a capacity payment. So they pay for the insurance explicitly. They don't just say, oh, well, you should really do this because the prices are going to go to infinity. So I think Texas, I haven't studied all the developments, but they're moving more towards paying for capacity, which is like it's like having your own backup generator. Right. So that's a better system because nobody wants to pay. It doesn't really work because the generators don't want to rely on these infinite prices. And nobody wants to get stuck with these ridiculous bills just because they were running their dryer for an hour at the wrong time, and then you get this crazy bill.
Right.
No, I think that'll be the ultimate solution, was to have that backup power.
Yeah. Well, and especially because we just have all this high growth to the state, and kind of higher economic growth here, and I think it's cooling a bit just because of the Fed. But any thoughts about interest rate rises, how you're seeing that translating into projects, and CapEx spending, that sort of thing?
Yeah, so one thing to note, that we think that the recent rise in interest rates, a little bit to do with strong US growth, but very hawkish global monetary policy. And we are studying Europe. Europe shrank their money supply by 500 billion over the last 2 months. We think they're going to go into a major recession. So we're actually have a non-consensus view that we're pretty bullish that rates are going to come down. But what's not happening in a normal cycle, rates rise, the Fed increases rates. And by the way, they've caused 11 out of 11 post-war recessions was caused by tightening Fed policy. So there's kind of a notion that we just randomly spontaneously go into recessions. Not true. Always created by the Fed. But normally what happens, the Fed raises rates, which they have already, and then housing collapses, purchases collapse, and production. There's mass layoffs. And also in other manufacturing that goes into housing, like consumer durables, dishwashers, etc. And then all those layoffs produce less consumption. But the numbers are not like people think. Investment drops by 13.4% on average, 11 recessions. Consumption's flat. No, consumption's normally 3.3, so it does come off. But the recessions are not caused by like student loan payments or animal spirits. Most of spending, 95% of spending, comes from employment and wages. So unless there's layoffs on the investment side, construction, and we haven't really seen, because of the IRA, the government really, for almost the first time maybe since the Great Depression, has done effective counter-cyclical spending by accident. So mansionomics and what I call cinemanomics, it happens to be very counter-cyclical because they didn't allow any of the safety net, and this is regardless of politics or just the economics of it, safety net spending go through, which would not have been counter-cyclical because the economy's at full employment. So the more the government spends, the less money there is to invest. But what they did is incentivize and just directly paid for construction effectively, or investment in chip manufacturing that's happening a lot in Arizona and near Texas. So that's why we don't think we're going to have the normal recession. Is this sort of by total accident, really just because although I'm sure Manchin would argue that he was aware of this dynamic too, that it's better from a counter-cyclical perspective to fund investment and not just helicopter money out to the population. But it's been highly effective, and that's why we think that economic growth is somewhere around 2%, maybe 1 to 2%. The Atlanta Fed numbers are likely to come down. It's at 4.8, because there are things like, rates are higher. It does impinge on some consumer spending. Housing would be probably stronger. It's pretty strong, but would be stronger. So we think a moderate growth in 1 to 2% is the most likely case, but people are afraid that it's going to grow faster right now.
Well, one thing I was wondering though, with I get what you're saying with, we had the infrastructure bill, the CHIPS bill, and the IRA, the three.
And there's, also strangely, there's money left over from the ARPA as well, because that was, it was $2 trillion. They can't spend it infinitely quickly. So there's still part of that budget still. It's like $300 billion that's still outstanding.
Oh, wow.
Which is strange. So it's really 4 bills.
Yeah. And so, the problem is the bill comes due too, right? At some point for this. And that's what, always kind of, I'm always thinking in the back of my mind is that the IRA legislation, if we are having this slow growth in renewables, as you're mentioning, because of the siting issues and because of the, best places being taken kind of thing, high grading, if you will, kind of like what they say in oil and gas, then if you're throwing a bunch of money still at all this, that's just inefficient use of resources, and the fact that this isn't capped, there's got to be a natural barrier when this can't happen, just like the EVs. I mean, there's got to be these barriers of physics almost at some point, regardless of how much, you're pumping through, a fire hose. I mean, I know you sometimes don't worry about these things, and I do. Would you have any?
Well, I do think that it's reasonable to say, okay, renewables for the last 5 years have grown to 10. Now they're going to grow at 20%, but it's off such a low base.
Yeah.
So it's really 5, 6,
Right.
7.2. So that's why, I mean, look, I'm an environmentalist. I don't like to breathe in coal dust.
Sure.
I don't like my kids to breathe in coal dust, which we do in the East. And so it would be wonderful if we had all renewables, but I've just, you become more realistic when you thought 35 years ago we would have all renewables, and now we haven't really made much progress.
Right.
You just see that trend and you get very jaded and say, well, I just don't think this is going to happen as quickly as you think it will.
Right. And then there's other sources like nuclear. There's a bit of there's some incentives for nuclear power, which is another area that might tick up a little bit, but like you say, it's all that's super capital intensive. It's going to be slow. Basically this transition is just like the past. It's going
to be slow. It would be best if we had a tax, because then there would be 100,000 ways to save carbon that we'd find the most efficient ones, versus what politicians think is the best thing, like to build charging stations, which may be actually increase carbon, because if they're in the wrong spot, then all the construction creates more demand for carbon. So we need to let the market decide and figure out more innovative ways to reduce carbon that aren't just the obvious,
right,
or more, not even obvious, but politically correct ways, like building renewables and electric vehicles. Those are unlikely to be the absolute best way to eliminate carbon.
Right.
And the market will figure it out. It could be heat pumps, it could be insulation. We don't know. You need to have way beyond the computing power that exists today to figure out those optimizations. But if you tax carbon, and people should relax about carbon a little bit, because if the earth is really being destroyed by carbon, then there will be the political will to tax or otherwise price it. And once it's priced, if you just raise the price fast enough, it will go away.
Right.
The market does operate. A lot of extremists, environmentalists don't either understand or believe this, but if you're really, really concerned about carbon, you need to have global pricing of it.
Right.
Europe found out they can price it, but all that does is make their economy uncompetitive. And they're really quite small. Europe generates about 4 billion tons of carbon, US about 6, China about 13.
Right.
But China is growing at 10 and we're flat. So if you just do the math, what we do doesn't really matter. Nobody wants to hear that. They want to worry about their carbon footprint. But it just does not matter. We need to get China on board, India on board. We need to price carbon.
Right. No, absolutely. Yeah, I get that. I was going to ask you one other quick question about midstream. What's kind of, given that there is this incremental growth still, and, we're not just kicking hydrocarbons, do you have any outlook on midstream? I mean, do you see more consolidation? Do you just see more potential LNG facilities being built? I mean, what do you?
Well, there's sort of 3 dynamics. The key growth driver is what you already mentioned, is export of natural gas, because that requires, it all comes down through what's called the mid-con. So it's kind of North Dakota to Texas. So if you're going to export, it's got to come from somewhere. So you need pipelines, and of course export facilities. So that's a huge growth opportunity. So our fund, AMZA, is tilted towards natural gas. It's not going to be supplanted by electric vehicles or anything, because you need the natural gas to generate electricity. So that's a huge growth opportunity. In terms of regulation, it's very beneficial to the existing companies to make it difficult to build new pipelines, because then you get monopoly profits on your existing pipelines. So that's why, even though Biden administration is, openly hostile towards hydrocarbons and pipelines, but nevertheless, these companies have done extremely well during this period, because there's no overbuilding, because you can't really build a new pipeline. So that's very positive. And the third thing about the sector, it's underappreciated. A lot of people don't like it because they remember it from 3 or 4 years ago, but the model, this also is true of E&P companies, they transitioned from being growth companies with no earnings. I would never invest in companies with no earnings, by the way. So they didn't have any earnings, they were spending too much. To value income and really dividend aristocrats who retain a lot of earnings, very cautiously invest. So that's why you're seeing these slow markets. So oil's not crashing as much as it used to because the production doesn't respond. It's called elasticity. So it's the response of supply and demand.
Yeah.
So I think that sometimes people overestimate them, but I think the people who are projecting $150 oil are underestimating them. That demand will collapse.
Right.
There will be more supply. And that's why I briefly referenced the 70s, because the US shot itself in the foot. They limited our production in the US. And so the world price went to nearly infinity. We had a 1,200% increase in the oil price.
Yeah.
The Fed still hasn't figured this out. That was what the problem was with inflation, not monetary policy.
Right.
It was super bad, horrible energy policy that in the 70s that effectively put a cap on US production. As I mentioned, didn't even benefit consumers because it just a bunch of middlemen, middle traders made a windfall profit. So, but these, because of the elasticities, there will be more supply, there'll be less demand. It tends to make oil more range bound. And I think people underestimate those elasticities. And so they get way too optimistic or too pessimistic about oil. And where if you look back at our ranges since the pandemic, they've been tradable ranges. In other words, like I said, like this year has been tradable because we stuck with it. Sometimes we do adjust it, particularly for the dollar, which is another headwind for oil because the dollar is appreciated by 5%. So that effective only 20% of oil is consumed in dollars, like basically the United States. So that's a headwind as well. So we think that our reasonable ranges is a better way to think about oil than these super cycles going to infinity or it's going to 50 because we have a regional banking crisis. A lot of strategists are tempted to do that because they can get on television and it's exciting and they don't have to talk about supply and demand and all these nuances around China and because the media doesn't really want nerds like us to get there and get into all the details.
The non-alarmists?
They just want a headline that doom is imminent. So, we're somewhat unpopular guests, but we do tend to be correct, which not a lot of people care about, but we do care about it.
No, definitely the midstream MLP area, I have learned just from doing some of the work that I've been doing over the last 6 months it's really, really intricate, but it is more boring, but it's good boring in a world that, is like feeding on extremes. So,
and to your point, there are fewer and fewer actual MLPs that have the tax characteristics. And that is buoying the sector. Like I was surprised that even 2 days ago when the market was pretty weak, MLPs were way up. They're up again today. So they're really acting quite defensive. And they're not as volatile. So they're perfectly acceptable now for stable people who want stable income, like retirees or near retirees.
Well, and Bill Gross just came out and pointed to MLPs. And I was like, oh no. It's going to happen.
It's a little scary. You wouldn't. It is scary if they get sort of be sexy, but
exactly. It's like, oh great.
The fundamentals are good, and finally, so that's a nice place to be after sort of 7 or 8 years of pain.
Right, absolutely, and that was largely just sentiment, policy driven. Just it wasn't based on economics and sort of like rational thinking.
I'd say I agree 100%. Really, it was a crash in oil, but
yes, that too.
But it is a better business model to have substantial retained earnings, so that you're not reliant on the capital markets for equity. And then, so what happened is oil came way down, and then the hedge funds kind of attacked the MLPs because they knew they had to issue equity and they would lower their price and short them. So when you don't have this kind of a dividend aristocrat model where you're retaining earnings, buying back shares, investing, growing earnings, slowly increasing the dividend, you're vulnerable to the capital markets, and that's not a good place to be.
Right,
There are very few companies want to be in that position.
right.
So that was the element that really hurt the MLPs, is they de facto were not ready for a down cycle in the equity markets.
Right, right. Yeah, because when OPEC did their price gauntlet in 2015, 2016, and then you had all the climate change discussion and ESG, and it was just kind of like a series of events, that have taken, like you said, 7-8 years to start course correcting. That's a long time. That's a lot of wasted capital if you think about it, and just market crazy.
It was a painful transition. A lot of investors suffered, but therein lies the opportunity too.
Yeah.
Because the sort of more intrepid investors who aren't climate extremists can take advantage of these sectors. They're actually helping the environment by increasing natural gas usage and get outsized return. Just like, I'm not in favor of smoking, but tobacco investors have outperformed the market when a lot of major pension funds divested tobacco stocks who actually had outsized return.
Right. Yeah. Funny how that works. Well, Jay, thank you for your time. Appreciate the color on markets. Is there anything else that you wanted to add that's kind of top of mind? No,
I would just urge everybody to focus on Europe, even if you probably don't normally do that.
Yeah.
See whether our fears that they're entering a deep recession is true, because that'll affect global capital markets pretty dramatically.
Right. Well, no, funny enough, I was looking at that ECB, what they were going to do a couple days ago, and I wrote about it actually in a Seeking Alpha article last week. And I do watch them, and I watch them for various reasons, because I have friends in the industry that do business there, and just kind of looking, and I have this upcoming two features in the DCEO Energy Edition, and there's some really interesting discussions about just global energy and Europe, and things like that. So definitely.
Well, I would suggest you write a article about the global monetary base. So that's a measure of global monetary policy. We do have that data on our website, InfraCap Funds, but most people don't focus on it or understand it. So people like yourself who write about it would be important, because everybody kind of just looks at the US when they're talking about the bond market. The global bond market is highly correlated, about 85% correlated. And this global monetary base is critical for affecting global bond prices. And I think it's poorly understood, and even truthfully, we didn't focus on it enough until recently when we had this big run up in rates. So I think it's a good education opportunity.
Yeah. Well, thank you for that tip. Definitely put that in the hat. Well, thanks so much, Jay. Appreciate your time on a Friday afternoon here. So
thanks, Jennifer. Thanks for having me again.